Hello, everyone, and it's great to be here. Today, we're going to talk about the trader's pendulum and how to ride it mindfully. So I'm going to be putting on my coaching hat today. This is Jody Samuels, and the subject of this week-long, full of wonderful sessions is about psychology and more. So we're going to focus a little bit about why traders do the things they do and how we can combat those habits which we want to get rid of. So let's get started. Today's presentation is based on my book, The Trader's Pendulum, The 10 Habits of Highly Successful Traders. And we'll go through some practical situations. And then at the end, I'm going to tell you about my one-on-one coaching program, where I'm going to work with a select group of students one-on-one to coach you to more success in your trading. Please read the disclaimer to yourselves, and thank you. The trader's pendulum, what is it all about? Well, I can certainly tell you what it is all about because my background was trading it for an institution for JP Morgan in New York on the foreign exchange desk. That was my initial foray into trading. So I worked on Wall Street for many, many years, and I certainly experienced the market pendulum, the emotional pendulum, and the financial pendulum, which prompted me to write the book, The Trader's Pendulum, The 10 Habits of Highly Successful Traders, where I took all of my experience at that time and just put it into a book. So what are these pendulums that I'm talking about? The market pendulum, you're very familiar with. It's the market trading up and down. So when the market moves up in a trend, it corrects, it comes back. So I use looking at the market cycles. I understand that the market moves in cycles and the market breathes, it moves, it accelerates forward, it moves up in trend, and then it comes back. And if we're in a downtrend, as we've been in the stock markets for the last, for a long time now until this week, we have experienced downtrends followed by corrections up. So that's what the market pendulum is all about. And we need to learn how to ride that market pendulum. We need to understand when to get in and when to get out, because that's how we're going to be consistent with our trading results. The financial pendulum is about making and losing money. So we're not going to be making money all the time, that's for sure. Trading isn't a one-way street. So on the one end, there are times when you make money. On the other end, there are times when you lose money. So both winning and losing are part and parcel of trading. Every trader loses money, make no mistake. But it's important not to bet the ranch, so that if you are in a losing trade, you lose the entire account. It's all about managing the money in the account so that when you win bigger than you lose. The emotional pendulum is best described with the fear and greed continuum. So on the one end of the swing, we have the desire to earn more money from our trades and might be driven by greed to take larger positions irresponsibly. And on the other end, we are in fear of losing money, and our actions might be held back by fear. So learning how to balance between these two factors, fear and greed, is the focus for you as an investor or trader. So these are some examples of the duality, the emotional pendulum swinging back and forth between fear and greed, self-doubting versus overconfidence, cautious versus reckless trading, organized versus disorganized, flexible versus stubborn, calm versus nervous. We're going to look at a few of these examples shortly, but first I want to introduce our characters, namely Fred and Farah. These are our technical junkies in the technical traders trap. You can call them hobby traders. They're out of shape. They have no business plan. They're not making money consistently. They lack discipline. They trade emotionally, and they don't have a trading plan. And when I say lack discipline, I really like to say that they lack habits that they can develop. Any trader can learn proper habits that will improve their trading. So you can ask yourselves, are you in the technical trader's trap? Do you jump from strategy to strategy? Do you continuously look for the holy grail? Do you have trouble focusing on the strategy that you're currently using? And if you've answered yes to those questions, then you might be in the technical trader's trap, but all is not lost because I'm going to show you also how to get out of it. And these traders, Steve and Stacy, have learned how to get out of it. They are transformed entrepreneurial traders. They're in shape. They've written a business plan. They make money consistently, and it took them a long time to get there, but they're doing it. They trade with discipline because they've learned proper trading habits. They trade unemotionally, not all the time, but they're aware of their emotions and they can temper their emotions. And they have clear trading plans. So there's a lot of clarity in what they're doing. In short, they're in shape. Now you can too move from the left quadrant to the right quadrant. The left quadrant, we have new and experienced traders in the technical trader's trap, or those that treat trading as a hobby. They get really excited by the ups and downs, like the roller coaster ride, the emotional roller coaster ride of the markets. And in the end, they're unsuccessful. But with a few habits, you can easily move to the right and become the transformed trader, like our entrepreneurial traders, successful. So new or experienced alike, it really doesn't matter. So this is the transformation process, moving from left to right. So I'm going to show you how we get there, but first let's talk a little bit about the emotional swings and look at some specific examples that you may or may not relate to. What is a pendulum? Something that swings back and forth from one course, opinion, or condition to another. During my trading lifetime, I have experienced most of the emotions that traders face, and these emotions behave like a pendulum. They swing from one extreme to another unless moderated. I view extreme emotions as part of a continuum where the ideal balance is somewhere in the middle. For example, at the fulcrum of a teeter-totter. Technical trap traders learn a lot from their fellow entrepreneurial traders, including how to moderate their emotions. Let's try and understand these pairs of emotions and how they impact a trader's bottom line and modus operandi. The first pair, let's look at fear and greed. Fear on the left, greed on the right, with the pendulum swinging back and forth. The fear scenario. Technical trader is struggling with taking risks. I'm afraid to take risk and cannot afford to lose my $20,000 account. I had double that amount and lost it over the last year when I was planning to trade for a living and leave my job. Now I am totally stuck and afraid to take a trade. Not being able to pull the trigger is about fear. If you are afraid to get hurt, feel pain, or lose money, you hesitate. The best way to handle fear is to treat every trade the same. If you believe that trading is a numbers game and that losses and profits come and go, they will be taken lightly. It's important to be able to move gracefully on to the next trade without carrying the emotions with it. As an aside, this technical trader ends up going for counseling and takes a break from trading for a while until he can deal with his loss. Greed scenario. Technical trader had 3 winning trades in a row and decided that she would risk it all in a trade that was a sure bet. I'm on such a winning streak that I can't lose. I'm increasing my position size so I can take that trip to Asia that I've always wanted to take. So greed can be a motivator and a barrier for making money. How is that so? When we trade based on greed, it requires an impulsive trading behavior to get into a market and not miss a move. Greed distracts us from the business of trading, which is to plan the trade and trade the plan. Technical trader ends up losing her gains plus some. So what can we do about this? How can we get balanced on the fear and greed continuum? Well, it is often said that the markets are driven by fear and greed of the masses. People have a natural inclination to want to achieve wealth, and so will follow the herd when a market is moving up with dollar signs in their eyes. And then when that investment or trade starts losing or the market drops, they fear losing their capital and sell so as not to take a loss. And I'm sure you've experienced this. The dynamics of fear and greed drive the market. So what are some tips that we can learn to temper the emotions? Well, instead of focusing on the money, why not learn to appreciate the rewards of trading? For example, trading offers an intellectual challenge to be able to take profits out of the market action and understand the market cycles, which might warrant different trading behaviors and even strategies. Trading offers a lifetime skill that can be developed and passed down. The trading process can be quite enjoyable if skills are learned and the markets are respected. There's always another trading day. In the long run, if trading is run as a passionate business, the profits will come. It's time to temper those emotions between fear and greed. So trade with money you can afford to lose and manage the risk so that you can accept the worst case scenario of every trade taken. And this is the mistake that many traders make. They don't understand the risk before the trade is taken and sign off on it. Literally, write it down on a piece of paper and just put your initials by it, that you understand the risk of the trade, and rather than taking every trade or a trade impulsively just because the market is moving and you don't want to have FOMO, fear of missing out. Very, very important to be organized in your trades and really understand the risk behind it. So let's move on to another one. What about the doubting versus overconfident trader? So doubting on the left, overconfident, all blown up, full of ego on the right. This is the doubting scenario. Technical trader is struggling with doubt. He feels shaken because his strategy or methodology is not producing the results he would like to see. I find myself closing my positions early because I'm afraid my system will lose money. I don't want to take any more losses. So, not trusting the strategy is about lack of experience and knowledge. That's one thing. The markets have changed and the system has broken down. So the technical trader needs to test it under different market conditions in order to feel comfortable trading it again. So it's just that confidence in the system. He needs to do multiple trades on a demo account or a paper trading account, get the results, review the results, and see how valid it is under various market conditions. So this trader trades his strategy in his demo account over a 2-week period and regains his confidence and is able to pull the trigger after that. That's really very, very important. If you find yourself into this situation, just trade for a day or two on a paper trading account or a demo account to get that self-doubt out of the way. Overconfident scenario. Technical trader became overconfident in her trading 1 week to the point of putting on trades without carefully managing the risk. So 1 week in, stop managing the risk. This position is a sure bet. I don't need a stop loss this time. Overconfidence can lead to a false sense of omnipotence. It leads to overtrading, excessive risk taking, and larger position sizes. Overconfidence distracts us from the business of trading, which is to plan the trade and trade the plan. So, technical trader learns this the hard way, feels the pain when she loses, and vows to be more prudent and carefully manage her risk next time. So let's see what we can do about this. It's often said that market wins give us confidence and market losses add to our doubt. And that's really not an easy lesson to learn. And the only thing I can say is if market wins really if market losses really add to your doubt and just make you feel bad, you might consider taking a smaller position until you can work out not having so many emotions when you make money and lose money. What the markets will do tomorrow or next week is far from certain, and without perfect information, it is quite common to feel uneasy when your money is on the line. And what happens when you practice a trading setup over and over again, only to see it fail when the market conditions change without warning? So, what are some tips to temper the emotions of doubting versus overconfidence? Well, instead of trading all day, enjoy the process of learning how to trade. Spend between 1 and 3 hours each week looking for high probability trading setups so that they are internalized and automatic and second nature to you. That's one idea. When in doubt, practice, practice, practice on your demo account or paper trading account. And when feelings of overconfidence creep in, try to balance these thoughts with a little bit of humility. In the long run, if trading is run as a passionate business, the profits will come. So it's time to temper those emotions of self doubt versus overconfidence. The flexible versus stubborn trader. Look at that flexibility. Speaking about flexibility, we went to Cirque du Soleil on the weekend. Whoa, that's what you call flexibility. That was an amazing show. I'm digressing. Let's find out about the flexible versus the stubborn trader. Flexible scenario. Entrepreneurial trader is flexible in both mind and body. She works out daily for her physical comfort, but she also exercises her mental flexibility. She has a trading methodology which she feels comfortable with and works under the assumption that she will have winning trades and losing trades. It's a numbers game. When she doesn't follow her plan, she immediately closes the position and moves on to the next trading signal. That way, I don't get stuck on any one view or position. Entrepreneurial trader will survive during bouts of trading losses. She will exhibit flexibility in her day trading by waiting until price gives her the signal to act rather than assuming it will move a certain way. It's not about being right or wrong, it's about following her trade plan. And her brain is wired to act when the need arises and not before. Entrepreneurial trader knows how to wait patiently for her trading signals before jumping in too soon, and she's learned it the hard way. Stubborn scenario. Technical trader gets very stubborn when she does her analysis in the morning and anticipates a market move. Her analysis is the correct one, and that's the bottom line. That's it. When the market moves unexpectedly in the opposite direction, she freezes and forgets her stop loss level. When she is in a panic state, it is difficult for her to act rationally and decisively. As a result, she loses more than she bargained for and more than her trading plan spells out. She exclaims, "Oh, how I wish I had kept that stop loss on this trade." Technical trader is advised to always keep her trading plan in front of her. Without it, she trades impulsively and doesn't react fast enough when the market moves against her. So she begins to keep a trading journal to document her trades as well. which is really very, very important to do. From time to time, we get married to a view or an analysis or a position and miss seeing the forest from the trees. How many of you have gotten married to your views? Has that ever happened to you? Remaining flexible in the body requires a consistent program of stretching those muscles. So why is mental flexibility any different? Let's talk about some tips to temper the emotions of the flexible versus stubborn trader. Complete a trade plan and stick with it. So that means pre-planning the amount of capital at risk before taking a trade. And once the trade is planned, stick to it. And that means stick to a stop loss, stick to your profit taking levels if that's what your trade plan calls for. In the long run, if trading is run as a business, the profits will come. It's time to temper those emotions. So we just went through 3 different situations that I'm sure many of you have experienced. And now we're going to talk about how to move from the technical trader's trap to becoming an entrepreneurial trader by developing some habits to get us there. But first, I'd like us to do a little exercise, and this is an exercise that is going to call for participation on your part. Please take a piece of paper and write down the answer to the question when I ask it. And many of you have heard that trading is simple but not easy. So you're probably asking, great, okay, what is the difference between simple and easy, Jody? Well, becoming a successful trader is about understanding the market and understanding yourself. So this is the exercise. I'd like you to answer the question, if the market were an animal, what animal would it be? And while I tell you a little story. So in the chat, you can type in your answers, please. Take the time to write down the answer while I tell you the story that Bill Williams used to tell one of my mentors. Before Albert Einstein died, he wrote to many of his former students and colleagues, and he decided to have a final audience with them in Princeton, New Jersey. He invited about 300 people. These 300 people got together 3 days earlier to decide what questions they would ask Dr. Einstein. The story goes that they argued over the important questions to ask him until on day 3, a scientist from Europe proposed that they ask Einstein which was the most important question that they could ask him. The next morning, with Dr. Einstein on the stage, they asked him this very question, to which he replied, "Is the universe a friendly place?" Before I told you this story, I asked you to name an animal that had the characteristics of the market. So let's see what some of your answers were. A reptile, a bull, or a bear. Okay. But the question is, did you choose a friendly animal or a threatening and dangerous animal? Many of our students select all different kinds of animals and give reasons for their choices. And my hope for you is that the market becomes a friendly place for you and that you grow as a trader and investor in sync with the market. So hopefully you've chosen a friendly animal, and I see some of you have. That's great. Now we're ready to start on habit number 5. Understand and exploit your unique trading personality. What trading style do you prefer? Short-term momentum or day, medium-term swing or micro trend, or long-term positions? So there are many different trading styles due to the simple fact that everyone is unique, and also everybody has different time constraints. So you might have a full-time job. and still treat your trading like a serious business, but you might not be available to day trade, for example. So, but let's focus on the different personalities which are better suited to certain trading styles. For example, if you enjoy sitting in front of the screen watching the market action and really understand price action and how price moves, you might prefer momentum or day trading. You might also lack patience and would rather take your profits in the day and then be free for the rest of the day to do whatever you want to do and not have to think and worry about holding positions overnight. If you like to analyze the markets and establish your trade plan and let your trade play itself out, you might be better suited to swing trades. You might set 3 different profit levels and hold the positions for 1 to 3 days maximum. And I'm going to show you shortly a trade management system, which I use, which you might want to start using in your trading. And as a long-term position trader, you're looking to hold your positions for at least a month if the market is going your way. For this, you need mental stamina, patience, and the ability to ride out drawdowns. I don't know how many traders have said to me, gee, why am I even holding positions during this market? The market has just, kept going lower. So that's a decision that you have to make. So now you're bringing into consideration, okay, well, what is the broad market doing? And what percentage, if you have a stock portfolio, what percentage of cash do you want to be in, depending on what part of the market cycle we're in. So we have a lot of factors playing into what type of trading we're doing, and not to mention our time constraints. But for the most part, if you like to day trade or if you don't like to day trade. If you'd rather just analyze and put in a position on and be able to hold it for the next swing move and then take it off. Don't forget to leave your profit targets. That is one mistake that I have made many times, where I don't set my profit targets, and then I watch the market go against me, which is why I developed the 3 Profiteers, which I'm going to show you shortly. So, by the way, there's no right or wrong style. The key is to finding the style that suits your temperament and lifestyle. Okay. And I see already that some of you are typing in what you like. Medium term, swing and long term, terrific. That's great. So this is a picture of a trending sideways versus sideways market. Well, it really is a trending market. You see the long-term red line there moving up. That's the uptrend. Higher highs and higher lows. The medium term is in blue. So we move up, but it doesn't look like a straight line. You have some pullbacks. The green line, let's say that's the hourly chart. Let's say the red is the daily, the blue is the 4-hour, the shorter term is the hourly chart. You're going to get a lot more opportunities to buy in to the trend on the retracement. So if the long-term trend is up, the medium term and the short-term trends will cycle through the trends and corrections, giving multiple buy signals along the way. So this is what understanding the market cycles is all about. And because the markets are fractal, meaning that the patterns repeat themselves over and over again, you will see the same patterns on all different time frames, from tick charts to the weekly chart. You will see these patterns, the same patterns. So what's important is that you learn how to trade the patterns, and you train your brain to be able to buy on a pullback and then take advantage of the next move higher. You might not want to buy as it's moving down. You might want to wait for it to turn around and start to be moving higher. But you've got to train your brain for that, because the brain is saying when it's moving down, oh, it's going to go lower. By the same token, you need a way to, maybe your strategy tells you that, I know certainly ours does. When you get to the top of the market, you need a way to determine whether the market is going to keep going or you're just buying because the market is buying and everybody's enthusiastic, and you don't want to have FOMO, fear of missing out. So you need a way to determine when the market is about to turn around as well, and understand that the market does move in trends and corrections. And this move to the right, this three-wave move to the right, that is a correction. Okay. Moving averages can highlight whether the trend is what the trend is, whether it's bullish, bearish, or sideways. So this hourly chart highlights the moving averages that capture the broad trends in this market. When the moving averages are pointed up and separating, the uptrend is in full force and the trader can buy the dips. So notice how the moving averages come together. They group together over here on this retracement, and then they separate again. So on the right, I'm reading when the moving averages are twisted and sideways. So in this box right here, you see the longer term moving average, the shorter term moving averages moving above and below the longer term average. The market is in a sideways consolidation phase, and it's best to wait for trend continuation before buying in an uptrend or selling in a downtrend. So you might just want to put a box around this and say, okay, tell me when we break out, and then I'll take action. I mean, you have to decide how you're going to trade it, but many traders do get chopped up a little bit during sideways corrective moves. So this just illustrates strong trends versus sideways markets. And you need to be in the strong trends. And when the trend ends, get out and then look to rebuy again. Habit number 5, understand and exploit your unique trading personality. So another thing that we can talk about, aside from momentum day swing or position, is what type of trading do you like to do? Are you doing conventional manual trading, where you are a discretionary trader? Are you a systematic trader, which is a little bit more mechanical? Have you actually programmed your trading platforms for semi-automation? And this can also mean, semi-automation can also mean using a scanner to find trades and then take action from the scanner, versus totally automated trading, which can be algorithmic, black box, and high frequency. So you have to decide where you fit here, because that is going to determine your trading system. This is all part of creating your trading system that you feel comfortable with. And I'll tell you, I started out as a discretionary trader working at the bank. It's definitely discretionary. And yes, we did have charts. We collected our own data, and we did have our own charts that I looked at every single day in making my trading decisions. And I learned about all the chart patterns, and we hired somebody from the Chicago Board of Trade to be our technical analyst on the desk, and he taught us all Elliott wave analysis, and he also taught us about pivot points. And he was a very valuable addition to the trading desk, because we were in the hot seat, certainly didn't have time to do analysis ourselves. So he was my in-house technical analyst that I could go to all the time. Now, of course, I do it on my own, but that was really valuable. And I was a discretionary trader. I didn't have a system that was programmed at the time. But now I can honestly tell you that I have evolved, and we have developed a scanner, and I'm still a discretionary trader, but I have a system that I use. And I find my trades through my scanner, and I have a specific trade plan that I use with that scanner. So I would say that with technology, certainly our company is evolving, and it's very, very exciting. And I'm much more comfortable now using a scanner to find the trades that we have traded manually for a very, very long time. So you have to decide what works for you. Habit number 6, follow a system. Discretionary and systematic traders have systems. If you look at highly successful organizations such as Microsoft, Amazon, or Walmart, you'll find that these companies are doing the same thing the same way every day with consistency. They find a winning formula and adhere to it. So ask yourself if you have a winning formula to get that edge, that trader's edge. If so, are you executing that formula or system consistently so that you have the confidence in your ability to follow it? You might have started out by going to lots of seminars, doing lots online these days, taking loads of courses, reading books, trying out everybody's system. But at some point, you need to stop jumping from system to system and mentor to mentor and guru to guru. Take a step back, develop your own game, your own system for your own trading style and temperament. And by doing that, you will develop confidence in yourself to follow it. So very important for you to take a step back and say, okay, what have I been doing for the last 6 months? Why am I doing it that way? It's time to get serious in my trading business and really figure out what I need to do to make money consistently. Week in and week, day in and day out, or week in and week out, or month in and month out. So part of the system includes setting up your chart. You might have indicators that you look at. You want to, if you do, then you want to dress up the chart with your indicators and know how to use them. You want to understand the markets that you're most comfortable trading with, the time zones and the time frames traded. And then you might want to come up with a set of rules, general rules that hold true all the time, reminding you to stick to the plan, for example. You might want to have those rules written out that you need to follow and that are specific to your own trading personality and emotions. Entry and exit rules. Yes, be clear on what triggers the buy and sell decisions. And the exits include the stop losses and the targets. So the entries include triggering the trade, the exits include your stop loss, where you're wrong, and the targets. Where are you going to take your profits? So following a system is really, really very, very important. Now, you might want to know what the difference is between a trading system, trading strategy, and a trade plan, because I've certainly thrown those terms around. So let's break it down. I look at the trading system as a collection of trading strategies. So that's what it is. It's a collection of trading strategies that you might have one to use during trend markets. You might have one that you use during bullish trend markets. You might have one that you use during bearish trend markets. You might have one that you use during sideways markets. You might have some option strategies that you use for different types of markets. You might trade Forex or futures and not trade options, just trade the underlying. So the Forex pair or the futures market, and you might have strategies there. So you just need to understand that all these strategies, I look at it as an umbrella, the umbrella being the trading system. So the trading strategy is a written out strategy with entries and exits based on however you're looking at the market, price action, analysis techniques, or chart setup with indicators. However it is, there's no right or wrong way. Don't let anybody tell you that there's only one way. There are many ways as long as you use it consistently. So trading strategy, you might have 1, 2, or 3. I don't know. And that comprises the trading system. Then the trade plan. The trade plan is the set of rules for when a trade opportunity arises. So these are the rules that you're going to use when a trade comes up, meaning where you're going to buy or sell, where you enter the position, and where you exit position. And you're going to exit the position, and you're going to write it down because it's important to be accountable to yourself. And one of the ways is to write it down. Habit number 7, plan the trade and trade the plan. The path to greatness lies not only in our performance, but in the systematic practice we put into it. So trading mastery is about internalizing patterns. Like I said, these patterns show up everywhere. It doesn't matter what market you trade. It doesn't matter what time frame you trade. The patterns are the same. Rehearsing execution skills, that goes without saying. Very, very important. Some of these platforms can be complex and you can put in all kinds of different orders. You need to practice and rehearse these execution skills before you go live. Learn from market feedback. Yeah, you're going to learn a lot. The market is going to teach you a lot. So will your P&L. And prepare your trade plan. So trading mastery is about all of that, internalizing patterns, rehearsing execution skills, learning from the market feedback, and preparing the trade plan. Now I'm going to show you a trading blotter, which you can just use as an example that maybe you can set up one up for yourself with all of these elements on it. The analysis, the checklist for your trading strategy, which will help you look for high probability trades, then the actual trade plan, and then you want to do a post-market review. Now you can look at this trading blotter as a daily blotter if you're day trading, or you can look at it as a weekly blotter if you're swing trading. And this is what it looks like. It's just meant to show you all of the elements that go into the day in the life of a trader. So on the top row, we have all the analysis, top-down approach. So we want to know what the trends are. On the left, what are the trends? We might want to know, if we're day trading, what the pivots are. So let's say we're trading the S&P ES. Let's say we're trading a Forex market. Let's say we're trading a stock, an ETF. You want to know what the daily pivots are, because the daily pivots will inform you where resistance is coming up and where support is coming up. And it's really uncanny how these pivots work. Now, I learned about pivots in the 80s when we brought on that technical analyst, like I told you about, and I use them today. They work. Fibonacci retracements. Because I am an Elliott wave trader today, I definitely use Fibonacci in my trading. So I want to know if the market has moved up or down a lot. I want to also know what type of correction I can be expecting. That helps me to determine what maybe my profit targets are. And then Fibonacci projections. So these are all things that can be customized for how you analyze the market. And then on the right, you want to do a little cross markets analysis, because we're in global markets. Like, we need to know obviously what the Fed is doing, what interest rates are doing, what oil is doing, what gold is doing. We want to know what is going on in the world. Maybe we don't want to know what is going on in the world. And then the middle row is the checklist. So the trading rules, and then whether you would go long or short, and what price will you use to get in, and your comments. So you want to have your trading strategy written out. And then on the right is your trade plan. When you actually find a couple of trades, you can write it down here. That's your trade plan. Are you going long or short? What is your position size? And your position size has to do with your money management strategy that you use. At what price will you go long or short? And then what is your exit strategy? Where do you set your stop losses? Where do you set your profit targets? What is your risk reward? And also very important is your reason for entries and exits. And then finally, your post-trade analysis down at the bottom row across. You want to just take note. What were your feelings before trading? Were you in a good frame of mind? Had my last couple of trades performed well? Was my personal life running smoothly? Was I in the zone? Did feelings of perfectionism creep in? Was I feeling overconfident? Because truth be told, if you're in a good frame of mind, your trading will most likely go well. And if you're not, if things aren't running smoothly in your personal life, you might make more mistakes than you do usually. And then actual trade planning. Did I plan my trade based on solid homework preparation? Did I get all of the confirmations I needed for my trades? Once I entered the trade, did I trade my plan? Was my trade impulsive or based on someone else's tips? Was I satisfied with my results or did I show regret? Did ego take over? And then the actual trade results are on the right. How did you do? Now, I just keep an Excel spreadsheet for every trade that I take, and all of my results are there because I also take notes there and I put my charts there. And I use a trading blotter, but it's an Excel spreadsheet for me. Okay, now I want to just talk to you about planning the trade and trading the plan with a little trade management strategy that I've developed. Now, I mentioned early on that perfectionism tends to creep in sometimes, where the market will go higher. And then let's say I would get out of my whole position and then it would still go higher and higher. So I developed this trade management strategy quite a while ago, which I'm going to tell you about in a minute. But they're basically 4 trade management strategies. 1, getting in and out all at once. 2, getting in all at once and taking profits at various levels. 3, getting into the position at various levels and getting out all at once. And 4, getting in and out at various levels. Now, strategies 1 to 4 go from simple to more complex, and which strategy to choose is a function of the trader's experience. And if you are in a very, very long trend, then you will want to build the position and get in at various levels, which would be strategies 3 and 4. Today, I'm just going to talk to you about 2, getting in all at once and taking profits at various levels. It's called the 3 Profiteers. It's good for maintaining balance on the fear and greed continuum, which is what we spoke about today. It's perfect for perfectionists who want to capture every last pip in the move. And this is the way it works. You determine the potential profit area. So assume it's 100 pips, or with stocks, $100 or $10. You use the Fibonacci sequence. This is the sequence, and pick 3 profit targets, the third ending at your PPA. So work backwards from a 100 pip PPA with the Fibonacci sequence to determine your profit objectives, 34, 55, and 89. Or with stocks, it would be $3.40, $5.50, or $8.90, or $34, $55, and $89. Set your stop loss at the first profit target, which is 34 pips in this example, and move your stop to break even once the first profit target is met. And your risk reward is adding up all 3 profit targets and dividing it by 3. So it's 1.74. Okay. Here's an example. These examples are old. I just have 2 examples, one for stocks and one for Forex. So this is the entry. This is an entry signal that we use in our system. So you buy here. This would be the previous high. So that's your profit target, your ultimate profit target. So the target is 680. Your entry is 580. It's $100 difference. So using the 3 Profiteers, you would set your targets like this: 34, 55, and 89. And you literally put your targets in. These are the 3 targets. You put your orders in your trading system, your trading platform. And this is right from the 3 Profiteers. Okay. The next is a Forex example where, again, you trigger your trade over here. You set your PPA over here. You work backwards. It's a 500 pip difference. Using the 3 Profiteers, that's 144, 233, and 377 pips. Those are the targets. And you set your targets in your trading platform. You monitor it. But the good thing about using the 3 Profiteers is that if price moves your way, you're taking profits along the way. and then you're moving up your stop loss. So at least you're taking profits, because in case the market turns around and then goes against you, you've locked in 2 out of the 3 profits, and the third profit will be taken out at profit target 1. So it's a way of being proactive in monitoring your position. I know I'm going over this a little bit quickly, but using the 3 profiteers and working backwards, the 3 profit targets are this number of pips. So your entry price is 124. You add 144 pips to that to get your first profit target. And then you add 233 pips to your entry to get your second profit target, and 377 pips to your entry to get your third profit target. And then your stop loss is your first the first Fibonacci level subtracted from your entry price. So that's the 3 profiteers. So what did we do today? Well, we did quite a bit today. We started out by talking about the trader's pendulum, and we looked at some emotional pendulum scenarios, 3 case studies, and we just learned 3 of the 10 habits of successful traders, and learning them will help you save time and effort, make more money, and achieve your full potential as a trader. So now, stock options, Forex, and futures traders, let me invite you to join my FX Traders Edge Next Level coaching program, so you can have your own personalized trading plan that you can follow with confidence. Jeff W. from Texas said, Jody Samuels has been my coach for over 1.5 years. Working with her has truly been rewarding. She has a vast knowledge of the markets and combines that with extraordinary technical expertise, patience, creativity, and discipline. My investing skills have definitely been enhanced by this experience, and she is spot on with her assessment of the 10 habits to become a successful trader. Success takes work, but the outcome is well worth the journey. So I'm going to present to you my next level coaching program. Work with me to create a blueprint for your trading business. We will assess your current strengths and weaknesses. We will assess your current situation and clarify your goals. We will develop a step-by-step plan to achieve your goals and outline the strategies, tools, and timelines to achieve your goals. We will discuss your capabilities to help you implement your goals blueprint, and you will have unlimited coaching support for 6 months. So how will this happen? We will start out, first of all, you'll be working with me. We will start out by doing a 45-minute starter session. We will work on your blueprint in a personalized 3-hour session, and can be broken up into 1 or 2 sessions. Usually we do it in 2 or 3 sessions. And then I will have a few follow-up sessions with you, and you will have unlimited email and coaching support for 6 months. So we will create a planning blueprint for your trading business. Now, I don't usually like to offer this because it's my time, and my time is really valuable as I get older. So, but I'm going to be offering this to 5 people. That's it. Getting started on your trading journey. Bob and I have been trading partners since 2015. We both read Jody's book. We had a very detailed planning session with Jody, which pinpointed areas which we hadn't even thought of yet. We both found her to be very intelligent, knowledgeable, and willing to understand our system and help us to make it more profitable. Her approach is a holistic approach which encompasses both technical trading ideas and how to make trading fit into our overall life. Thank you. A recent coaching client. I absolutely love Jody's coaching program. It is a one-on-one training where you have a say and together find out what type of trading you are most comfortable with. Jody has a ton of experience and patience. I learned how to really have a trade plan and trade the plan, and I'm light years ahead of where I was. Thanks, Jody, for all your patience, and I look forward to continuing as your client. Whoops. So, next level coaching program. I'm offering this for $797. private one-on-one sessions. You can sign up at fxtradersedge.com/next-level-coaching. That's the email that's posted in the box. The case for a coach. Manchester Inc. surveyed executives, most of which were from Fortune 1000 companies. Their research showed that a company's investment in executive coaching realized an average ROI of almost 6 times the cost of the coaching. Okay. According to the International Coaching Federation, 86% of organizations saw an ROI on their coaching engagements, and 96% of those who had an executive coach said they would repeat the process again. Behind these results were tangible as well as intangible factors. Tangible factors were areas such as increased productivity, higher levels of overall employee performance, and higher engagement. Intangible factors were increased confidence of those being coached. Now's the time to be coached. We just went through a horrible start to the year with the market selling off for those of you that hold positions, hold stocks. And now's the time to gain clarity so that you can really, really maximize the rest of the year with your with profitability. So now's the time to sign up for coaching. And the day came when the risk it took to remain tight inside the bud was more painful than the risk it took to blossom. It is my hope for you that you all blossom as traders. And again, I'm taking on 5 clients. That's it. So sign up today if you're interested. Next level coaching program, $797, private one-on-one sessions with me. If you have any questions, you can contact me at Jody at fxtradersedge.com. Okay. And I see a question, how long is Jody's coaching sessions? 6 months or a year? It's 6-month program. And but I certainly don't give up on you. We do have follow-ups, even that anybody that reaches out to me, coaching client, I will never turn down. I will never say, sorry, your 6 months are up. Never. Okay, so thank you very much. It's been a pleasure. I hope you enjoyed this presentation, and I look forward to working with 5 of you. Thank you, David.